Hey guys, welcome to another session with Short-Term Metrics, the only YouTube channel that helps you get out of this race and this absurd calling metrics. And if you guys remember in yesterday's videos, we were preparing for the FOMC meeting minutes and how it would affect the global economy and what the Fed has to do with inflation. Do they hike? Um, are they pausing? Maybe they cut? So in this session, we will go over the things that that the Federal Market Open Committee has decided and have spoken about yesterday, and see how can we apply it to the charts, and of course understand where we are at economically. So, basically, since the last FOMC meeting on June 14th, when the Fed paused its hiking cycle, but of course pressed its view via dots that the cycle has at least two more hikes in it, we can see that gold and bond prices are down between 1 to 2%. So if we go over to gold, we can see that from yesterday it had dropped down all the way. If we look at the bigger picture, then we can see that gold has another drop to occur. According to the cycles, of course, I would be expecting 1833 in that case, maybe a little bit of a retrace up before we dump back down. But going back to the to our topic, let's go over to the bonds, and we can see indeed that the bonds on the hourly chart, on the daily chart, have taken a dump, and as you can see also on the hourly chart with the gap right here, maybe to be fulfilled before going back down. So as you can see, bonds are down, meaning probably that yields are going up. Indeed, the 10-year yields are shooting up. With the dollar basically flat. That's what happened yesterday. We all anticipated something, but as you can see, we're still within that range that we highlighted a couple of sessions ago. Um, Stocks have also rallied notably, but crypto has been the bigger winner. So if we go over to the US 100, we can see the spike, but they came back down to the same place they were yesterday's morning. So really, all of this is one big manipulation before the non-farm employment change which we have today. So going on, we'll go back to the DXY. Basically, all of that is odd, given that the market expectations for Fed action has shifted significantly more hawkish, despite the pause. Of course, when we're talking hawkish and dovish, those two terms are referring to hawkish are people who stand for more tight monetary policy, meaning aka raising rates. Let's just make it simple. And dovish meaning people wanna um, make the monetary policy a little more loose, meaning we have more room to breathe. Um, so in regards to that, let's see what the minutes has said. Let me grab this right here. This is an article written by Zero Hedge. So I highlighted the important stuff, and which we will discuss, of course, as we go through it. So the summary of what the minutes said yesterday. In consideration of significant cumulative tightening in the stance of monetary policy and the lags with which policy affects economic activity and inflation, almost all participants judged it appropriate or acceptable to maintain the target range for the federal funds rate at 5 to 5.25% at this meeting, meaning almost all of them didn't want to raise rates yesterday. They wanted to reassess, they wanted to have some time and talk about it. Of course, there are some participants indicated that they favored raising the target range for the federal funds rate by 25 basis points at this meeting, meaning yesterday's meeting, a couple of hours ago actually. Or they could have supported such a proposal, meaning this wasn't off the table. Raising rates, surprisingly, yesterday was not a surprise. And if we talk about future hikes, almost all, as we knew about it yesterday, almost all agreed more to come. If you remember, 80% of the traders out there were pricing in one more hike. Um, so let's continue. In discussing the policy outlook, listen carefully. All participants continued to anticipate that with inflation still well above the committee's 2% goal and the labor market remaining very tight, Maintaining a restrictive stance for monetary policy would be appropriate to achieve the committee's objectives. Okay, so here they tell us that they still have that goal to get the inflation to the 2% mark, but that the labor market is also very tight. Meaning Fed has to turn more hawkish than right now. Almost all participants noted that in their economic projections, they judge that additional increases in the target federal funds rate during 2023 would be appropriate, meaning this is on the cards. If they didn't raise rates yesterday, it doesn't mean they won't raise it again in 2023. They still have job to do. Inflation is well above the 2% target. So if we continue, in summary, the hawks on the FOMC wanted to raise rates in June, but agreed to a pause with understanding that the Fed was committed to raising rates later in the year. Almost all of the FOMC wants to tighten further, meaning the Fed is hawkish. They are looking to raise and spike and hike rates this year. Most of them wanted to do it yesterday in June, but they also agreed to pause, understanding that the Fed and them actually will raise rates again during this year. S- so meaning the Fed is hawkish till the end of 2023, of course. And now, if we go to the final word, finally, Fed staff economists continued to forecast a mild recession starting later this year. They can't get the grasp of what a mild recession is. These guys act like a recession is something so horrible, but of course it has its horrible points. But of course, in this type of economic behavior we have these days, we need to have the recession. We need it. So now that you guys understand, you can expect that the Fed has remained hawkish, which would be kind of a problem for the DXY to go down to repack lower, unless this is already priced in. Okay, so remember what we have said, we will wait till DXY breaks this range to either side and then continue before going any further. Okay, so it's important for you to understand this. I hope this helps. I hope you guys can win the Fed over and over again. Just be cautious with your trading, and you know, you trade you. Okay, don't trade the noise. Don't trade the Fed's perspective. You trade what you see in the charts, and we'll of course dive deep into that on the next sessions. Thank you guys for joining. Please like and subscribe if you like this video or content, and I'll see you next time. Peace, guys.